We are live. Welcome to our Trade Alert webinar. Biden, you have pulled it off, buddy. Here's what we're expecting. A tsunami of money printing is about to pound markets. Rather than end the war and sanctions, Europe, which is being guided by the US, wants to print trillions of dollars to subsidize energy costs and keep the sanctions rolling on Russia. Let's crush Russia. Japan will print to protect their bond and currency markets. They have to. The inflation is pushing massive pressure on their massive bond and currency problem. Meanwhile, China's real estate market's been sinking for a year. Add to that zero COVID policy, their economy is on the brink of collapse, just like 2015, before we got that massive melt up all the way up to 2018. And meanwhile, the US is going to enjoy running a $1 trillion deficit or greater. And the plan is to grow that to $2 trillion in a decade. And with interest rates this high, the US is just a magnet for money, sucking it outside of the rest of the world. So buy these 6 stocks to get rich by Christmas. So the plan is essentially to bet that inflation is going to top off and fall. All the catalysts are slowly playing out for this to be the case, and that's going to be where we make the big money in 2022 and into 2023. Now, remember, we made the big money doing the exact opposite, so we're not a one-way shop here. Our high-risk portfolio is batting at a 37% total return year to date after returning 233% last year. Now, this year's been far more difficult to make money than last year, but we're still aiming to add a lot of gains to that to close out the year. Here's what our high-risk strategy is using per unit right now. We have 6 positions, 3 on the defensive deflationary side, and 3 on the offensive inflationary side. Now, again, if we think that the inflation is going to cool off, we want to be long the inflationary offensive assets. That means central banks are going to ease policy. If we think the inflation's rising out of control, we want to get in the defensive camp, because that means central banks are going to tighten monetary policy. So our portfolio is pretty well balanced, but we're getting ready to load up on the offensive side in the near future here. Probably next week after the CPI print on Wednesday. In fact, we're going to move the webinar next week to Thursday so we can consume what Powell has to say next Wednesday with rate hikes and forward guidance, and then put money to work next Thursday. Most likely we'll be exiting EUO and potentially moving FNGU and then holding NRGU into winter. We'll talk about all that and more. But per unit right now, our portfolio has the following. We're going to pull up our handy little tools so we can see with UVXY, we have 19 shares. Coming in at 8% of the portfolio. This is your stock crash insurance. This has been a little bit of a dud product this year with all the volatility. Even yesterday, the big drop barely made UVXY go up. So we've been hesitant to add to this position and have been letting it just ride the wave so far. Treasuries. This is a play we want to get more aggressive on in the future. Keeps getting beaten down. The Fed is talking about hiking the federal funds rate beyond 4%, and with the long end only at 3.7 and the yield curve inverting, probably getting very close to the time where treasuries are going to rip higher. Right now, this is 36 shares of our portfolio, representing only 15% of the portfolio. When the time's right, we can go ahead and double down on this position, but we're going to hold off on that just for the time being. And we'll talk about that more in the Treasury section. We've got a big cash position. If Powell's really going to reduce the balance sheet by $3 trillion and push the federal funds rate above 4%, probably the only thing that will make money in the whole world will be the UVXY and the dollar. Okay, now I don't think that's what they're going to do into midterms, but if that's what they tell us come Wednesday, we won't fight the Fed. We might even have to get a bigger dollar position. If they do push that federal funds rate way above 4, there could still be more pain in treasuries. I find it highly unlikely. When the US has 32 trillion in debt to roll over, it'd be suicide for the US. So we'll talk about that more once we go through each trade alert play-by-play. Next, per $2,414 invested, we have a position in the Grayscale Trust Ethereum. That's this line right here. Now we're using ETHE, so you can buy this in your stock account. You're going to pick up 57 shares per unit. It's going to represent 28.5% of your portfolio. And again, this is our favorite growth asset. The merge is happening tonight. This is going to be extremely bullish for Ethereum. I'm most likely going to roll the FNGU position completely into ETHE for the high risk. Now, I like the big tech giants. We're going to move that over to the safe growth strategy, which I'll cover over at the end. But that's definitely a play we're looking at next week. FNGU is a leverage play that has a very similar return to ETHE, but I think ETHE will outperform with less risk and greater growth. So that's where we're going to roll it in. This is the 12 giant monopolized tech companies leveraged times 3. Right now, that's 27 shares. Again, with 3 times leverage. We'll look at that in more detail later in the presentation. Now we got to look at what's about to happen. The NRGU play could go parabolic here into winter. So we made a lot of money on Boyle. It sold off. It's bouncing back again today. If you looked, it's up 15%. NRGU has been up as much as 10. But here's what's coming. The West wants to crush Russia, and they're actually talking about putting price caps on Russia and going after all the middlemen who've been allowing Russia to escape sanctions. So this means creating a lot of tensions with China, India, and Greece. And the most likely outcome is Russia will simply cut off all oil. Goldman Sachs predicted this could take oil to 300. If that happens, your NRG is going to go screaming higher, and every other asset in the world will likely crash outside of the dollar. And with the Ukrainian offensive whooping some ass, taking over quite a bit of territory here and making Putin look bad, he's really got 2 options: escalate or resign. And I think he will escalate here. So we'll cover more about the war developments towards the very, very end. Right now, this is 1 share of NRGU. This is the 10 big US oil gas companies with the Biden administration. They hate all the little guys. They're just letting these big monopoly oil companies dominate the market. So we like NRGU times 3. Warren Buffett has taken over 50% of one of the companies in NRGU. Okay, so very good. That's, again, the strategy per unit. Now, if you upgrade, if you're watching this on YouTube because you're not a paid member, note that when you upgrade, you get access to the software. You punch in how much money you want to invest, hit calculate, and it tells you exactly what to purchase. Okay, so let's go ahead and go to the next screen. And again, if you want to upgrade and gain access to the membership area, it comes with actually a free call with my father who'll walk you through the whole membership area. Call Dean now at 505-322-7515. All right, let's go through the trade alert step by step and back up why you should own each of these positions. Step 1, buy 19 shares of UVXY, the crash hedge. One of my favorite hedge fund managers is Jeffrey Gundlach. He went on TV and says, the president staged a celebration today about nothing and yelled about the promise of America, whatever that means, being real, real, real. The stock market tanked while he was doing the speech, and inflation did not ease. The president acted like it did. And of course, he was signing his Inflation Reduction Act. Zero Hedge says the last time stocks dropped this much, Tony Fauci was about to lock down the world. And a reminder, when they did do that, S&P 500 fell 25% in a single month, sending UVXY up over 1,000%. So the bear case, which we'll talk about, UVXY will be the best play to benefit from that, even though it's been a little bit of a dud this year. Now we can see in the past month, UVXY is up 16%, and over the past 3 months, it's down 38%. Here was another tweet and photo from yesterday, where again, the inflation came in way hotter than any analyst expected. the stock market dumped and the expectation for dramatic interest rate hikes next week, Wednesday, rose significantly. Biden celebrating record high inflation as a great day as he fumbles through an embarrassing speech while the Dow tanks live on screen is the defining image of the Biden administration. Okay, so here's the case for a big crash. Now, again, I'm not in this camp currently, but as you know, I thought the CPI was going to actually be flat or down yesterday. Otherwise, we've been better prepared. And so this, I won't read every single line of it, but this is Jordan Johnson. And here's the case for perhaps we've got problems and we should be worried about a bear market that gets worse than where we're at right now. Services inflation is the new boogeyman driving the runaway inflation train, and it seems thoroughly entrenched. So what happened today? Well, while energy prices, gasoline in particular, plunged, core CPI, which excludes food and energy, jumped, and service inflation experienced another ruthless spike. In fact, today we learned that service inflation saw its 12th straight month of expansion, a sign that inflation is now solidly entrenched and getting worse in vast swaths of the US economy, a nightmare for the Federal Reserve. Overall CPI inflation was 8.3% in August, down modestly from 8.5% in July, yet still way too high and up 0.1 month over month after July's 0% rise. And in what is likely a nightmare for the Federal Reserve and the transitory pivot bulls, the CPI for services spiked again, jumping 0.6% in August month over month and 6.8% year over year, making the worst increase since October of 1982. Simply put, services are a huge part of the US economy, and now the boogeyman for the transitory inflation bulls and largely unaffected by energy prices. Moving to core CPI, which excludes the volatile food and energy components, and also the metric the Fed is historically focused on, the 0.6 month over month jump, given this index designed to measure the broader economy, regardless of commodity moves, this is no doubt scaring the Fed. Okay, we had food jumping 13.5%, rent jumping 12%. And so the argument is that while we have had commodities crashing, the inflation is still spreading rapidly through other parts of the economy. We're not going to get that CPI falling in a timely fashion for the Fed pivot. 31% of the total CPI is on rent. And this has been driven mainly by the Fed's $2.7 trillion purchase of mortgage-backed securities, pushing up home prices. Okay, so again, I'll skip through it. A lot of content there. And then we got the wages still rising rapidly. So that's the great bear case right there. And then you couple that with potential suicide sanctions on Russia into winter. You could see how we could have some inflation problems for longer than the market was anticipating. This chart's reminding us that when the dollar is driven too high against other currencies, specifically the euro and the yen, you've ended up with big problems. And essentially it just crashes foreign economies and then leads to a global recession. Also, and typically due to inflation, you end up with the Fed overdoing the rate hikes and ending up with different crises as well. Now this chart's showing you all the crashes that occurred with too high of a rate hike path. That's not telling you all the times they have pivoted and saved the market. This chart's looking at 100 years, 120 years of stock returns. Most of us are really trained to think that stocks always go up, they'll always recover to new highs. And that's been the case since the 80s, as we've had interest rates falling for 40 years. Previously to that, though, we had a 16-year volatile market due to inflation. During World War II, we had between World War I and World War II, we also had two really bad periods of time, about 45 years of bad markets for stocks. Outside of the roaring 20s, you got the Great Depression and all sorts of other problems in the stock market here. Okay, so we're prepared for a crash if we really think that's the case. That's not what I'm expecting and not how we're positioning. even though we have some hedges in place. Step 2, buy 36 shares of TMF, the deflation hedge. Okay, so here's what upset the bond market and put the TLT back at 107, even traded at 106.50 for a little bit yesterday. United States core inflation, after having a trend of going down or sideways since March, reversed course and suddenly jumped 6.3 from 5.9. This caught everybody and their mom off guard. Friday and Monday, we had this epic short squeeze driving stocks higher, massive amounts of capital flowing in, and then we got this devastating CPI print that essentially reset the bond market and reset valuations in stocks in a split second. Now, what's driving that? Primarily rent, food, and services. So we can see these have been going up parabolically without any sort of pullback at all for well over a year. Rent, food, and services. Another look at the rent. So this is problematic. Now here is the monthly rent hitting a new high. And again, this is lagging housing prices by about 6 months. I want to point out the housing market topped in January and February. So it's quite likely rent is about to top out here and fall. So that would be good news for that. Now let's look at what the bond market's telling us about these rate hike expectations. So now the hype is that they're going to get the federal funds rate to 4. And so what's happening is the front end is rising to where the federal funds rate's going to go, but the long end of the bond market's not believing that this is sustainable. That's essentially going to crash markets. This is typically when the Fed will pivot when you invert the yield curve. Because what you're going to do is you're going to stress out the ability for the government to raise capital. Why would you want to lend the government money on the 10-year for 3.4 when you can go do a much less risky loan for a year and get 3.7? So when the yield curve inverts here, puts tremendous stress on the entire duration of the bond market and the ability for the US to raise $1 trillion deficit it's going to have this year. So here's the breakdown, but the bad one was the core jumping from 5.9 to 6.3. Now, Gunluck also come out and says buy long-term treasuries in spite of the fact the narrative today is exactly the opposite. The deflation risk is much higher today than it's been for the past 2 years, TLT. So he was suggesting the Fed should do a 25 basis point hike, otherwise they're going to overdo it. Elon Musk says a major Fed rate hike risks deflation and actually recommended a 25 basis point cut. And then Larry Summers, desperate to take over Janet Yellen's job, recommending a 100 basis point rate hike. He wants to soar unemployment and be the Paul Volcker of our time. This is a roadmap for how the economy responds to changes in rates, and if we can see if it's working. So the first thing that should be slowing down is the housing sector, and sure enough, it is. It's rapidly cooling off. Prices are falling, and the amount of inventory going for sale is skyrocketing. So we're highly confident that inflation is topping out and that it is going to fall. The exact timing has been difficult here. So let's take a look at what's coming out this week. So yesterday we had the CPI. That came out really bad. The PPI came out today, not so bad. It's actually cooling off. Retail sales are remaining strong. We'll get an update on that tomorrow, of course. And then we have the FOMC decision next Wednesday on the 21st. So these are the big items to focus on. Michigan consumer sentiment probably still really bad, which we'll look at a little bit further. So why so much pain this year? It's the biggest crash in bonds in 40 years. Everything is related to bonds because that's how you loan money out. So the cost of money is getting extremely expensive the further the bond market crashes. And we can look at historical comparisons. There's nothing like it in history, at least in the last 40 years. Now, Wall Street Silver has a good comment here and why you shouldn't believe the bond market's going to be allowed to crash indefinitely. Probably we're most likely at the bottom. We didn't get a new low, but we got very close yesterday for the year. Over the next few years, 31 trillion in national debt matures and we'll have to get refinanced at 4% or higher. This is assuming we really do keep interest rates that high. It's not going to happen. The interest we pay on the debt will be more than double, from 600 billion annually to 1.2 trillion per year. Okay, again, that's why they're not going to allow that to happen. Here's a look at the CPI broken down per item, and we can see a lot of the items that were leading the inflation are now falling, and some of the items that respond lagged are still showing inflation. That's why I'm not freaking out thinking we're going to have runaway inflation here. A lot has to do with the labor force and the amount of debt we have is highly deflationary. We can see energy, electronics, and airlines all falling dramatically in this print. And we're seeing it's really the services that are still pushing these higher, and food. Now here's a look at CPI year over year next to the change in household net worth. We have just deleted something like $14 trillion worth of household net worth. So I do believe they have done the job. They've wiped out a lot of gains in various markets. They've driven interest rates sky high. The economy is absolutely about to slow down dramatically, and the risk is to overdo it. Here's a look at that PPI falling. Of course, this is good news if we want the CPI to begin falling. And of course, PPI is going to lead CPI. So first, the producer price index rises. Later, that gets pushed to the consumer. And now we see the PPI is falling. So this is very good news. Another look at inflation is to compare it to the ISM manufacturing. And again, we can see ISM has been falling for quite some time. So I believe we're not only going to see inflation flatten out here, start to fall rapidly. Now, David Rosenberg is a huge bond bull, so got to understand that. He's always a bond bull. And so his big trade was to go long Amazon and Treasuries this year. So that was a double whammy bad trade. But he's a smart guy. Let's pay attention to what he has to say here. Sometimes people get the timing wrong, but they have the right idea. As the Fed goes wild over inflation, yesterday's story, it is aware that rents are slowing, used car prices are falling, commodities are in a bear market, supply bottlenecks are easing sharply, wage rates are settling down, and freight rates are tumbling. Here's a look at the direction of home prices, and we can see the red area mostly decreasing, has gone from essentially 0% in January to 35% are dropping prices by July. Gas prices are falling. Now, questionable if they stop doing the SPR release in October and simultaneously start trying to punk Russia, China, and India around, you're likely going to get a new spike in oil costs. So this could turn around quickly. We'll keep a close eye on that, and remains a great risk to markets, and why you own NRGU in both portfolios. Okay, so we're 15% long treasuries. We'd like to get more aggressive in that. We've been very, very patient, and we'll remain patient. Right now, TMF, which is a leveraged product on the 20-year. Now remember, the 20-year is trading higher than the 30-year. So you're getting that absolute highest interest rate in US government debt when you buy TMF. It's trading at 10.24. Long term, I see this getting close, but perhaps not as high as the global lockdown high. And that really was probably the most deflationary event in history to shut down the entire globe. Okay, so will they do it again? Who knows? But I certainly believe we will be getting back to the 150 to 170 range, depending on what sort of events occur. And that'll primarily just be to help grow global debt from the $120 trillion. And it's going to keep marching on indefinitely here to keep civilization running here. The only way that happens is interest rates must fall. So we love the TLT long term, and you're getting it after a 2-year bear market that's really historic. We have not seen a crash like this in quite some time. And we're talking in the last 40 years, we haven't seen this. Other bond markets had a similar experience, a little less volatility in the LQD, but it's bottomed out, looking good today. The junk bond market recovering here. Here's where a lot of the pain hit markets. Not so much the long end of the bond market, but the 3-month, 1-year, 2-year all shot up rapidly with that CPI print. And you can see it's the fastest rise in the short end of the US bond market in history. And it's not going to last. This is going to top off and crash back to zero and keep the trend going. Here's that 2-year hitting 3.7. So it's still not pricing a 4% federal funds rate yet. If we get another bad CPI print in October, it very well could jump again towards 3.94, and we probably have more pain in the market. I'm expecting October to be a good print and be very bullish for the November meeting into midterms. So we'll see how that plays out. 10-year, similar chart, just not as bad. And we can see not as bad of a return on the 10-year compared to the front end. Same chart on the 30-year. It's way out of its trend and highly unlikely to stay at this level for long. So we're getting ready to pounce on the long end of the bond market, as Jeffrey Gundlach recommends. Here's the Italian bond market. They're now using German bonds to pay for Italian bonds. It's quite a mess. The governments in Europe are now planning to bail out the energy sector. They're putting caps on your total electricity bill, so people are going to go wild with their energy use. There's probably going to be shortages. This is not a smart plan, but they want to keep the war ranking on, so that is their plan. And it's going to force them to print money to protect their bond markets, because the more money they spend, the higher interest rates will go. Here's a look at lumber futures. So again, we're looking at some of the inputs for inflation. They're all down significantly. We got lumber futures down 57% year to date. Copper futures have fallen significantly, down 20% year to date. Baltic Dry Index down 38% year to date. We're starting to get a little bounce on a lot of these though, which is important. Wheat futures down 18% year to date, and we can see this sudden spike in inflation that has caught the world off guard and caused all this pain in stocks and bonds simultaneously. This will get an update tomorrow. The University of Michigan Consumer Sentiment. Typically a great time to buy is when the consumer is as pessimistic as possible, which is what they're at right now due to the inflation. Now, initial claims are starting to fall, showing the labor market's still hot. We got 2 jobs for every 1 person looking for a job. Here's the yield curve inverting. This is typically when the Fed will ease off. Otherwise, risk putting a lot of pain on the bond market. And so we'll see. They are definitely pushing the envelope here. Okay, step 3, buy 14 shares of EUO. This is the quantitative tightening hedge. So again, if essentially we're betting that the dollar is going to go up against the euro, which makes a lot of sense. What we're doing with sanctions seems to be designed not to really crush Russia as much as it's going to crush Germany, France, and Italy, who are starting to become more and more independent and really reliant on Russia and China as allies. So this war has effectively definitely hurt Russia significantly. It's caused China to have to go into almost a year-long lockdown because they can't afford food or energy costs, and it's crippled all of Europe. So the winner here is obviously the dollar, which has been going straight up, and the U.S. And so we can see a 29% return on EUO year to date, betting on the dollar against the euro. And unless all this craziness with sanctions ends, Europe's going to go further and further into recession, depression, and a weaker currency. So this play could work for quite a while, as long as the war marches on, which again, there seems to be no end in sight at this point. And it's hurting everybody's currencies. So we can see the euro is losing against the dollar, down 13% year to date. The Japanese yen, which they're now talking about protecting the currency and the bond market, which means massive money printing, is down 23% year to date. And the Chinese yuan is now being intervened and protected as well. So the China is having to print money. Now the problem is they oftentimes will sell U.S. assets to protect these products of theirs. The only currency outperforming the dollar this year is the ruble, and that's because they have a higher percentage of energy exports compared to the U.S. Now here's a look at the balance sheet for the U.S., and they've slowly started doing quantitative tightening. They're way behind schedule. They're talking about dumping $3 trillion of assets. Now, they've never done that in history. When we had a really good economy under Trump, they tried to dump $500 billion slowly over 2 years, and you got the Christmas massacre, which led to what they called not QE, which was the reverse repo, where you can see that started to build up. Let me get my pointer out. So here's where they tried to do some quantitative tightening under Trump's watch. It blew up all the markets. So they started doing what they called not QE. And then they did the global lockdown, which allowed them to get away with $3.5 trillion of stimulus, which was mostly handouts, and ended up doubling the balance sheet. So yeah, there's zero chance they're going to successfully sell $3 trillion of assets without some shenanigans. And some of the shenanigans they're talking about is essentially letting the banks gobble up all this and then give it back to the Fed with some sort of reverse repo to flood the economy with capital. So we're keeping a close eye on that as we start to really get into it. Europe's trying to reduce its balance sheet, but again, if they want to spend trillions bailing out the energy sector for consumers, then of course they're going to have to protect their bond market. There's no way they can increase stimulus and do quantitative tightening at the same time. Lynn Alden points out that the M2 supply has gone flat this year as the US tries to fight inflation. I want you to look at how often the US has been able to get away without growing the M2 supply. Almost never. So this is likely to start growing very soon. Otherwise, big problems will occur. And it's going to be coming from foreigners who own $40 trillion of our assets. So if you make foreigners' currencies crash against the dollar, they're going to start selling their dollar-denominated assets to pay the interest on massive amounts of debt denominated in dollars. So these high interest rates and strong dollar will end up being massively problematic for the US the longer it goes on, and why it's unlikely to be allowed to go on for too long. Step 4, buy 57 shares of ETHE, the ultimate growth asset. So we got a triple bottom forming here. I want to point out that the double bottom for Bitcoin, the triple bottom hit 16.5, 17.9, 17.9. With yesterday's volatility, we hit 20, went below 20 for a slight amount of time. But in general, what I see is higher lows in each volatility event, which could be leading to the next massive explosion in cryptocurrencies. Now, this is estimating a 5.5 times return, which puts us around $140,000 Bitcoin in this cycle in about 2 to 4 years. So that seems quite realistic, and you can see the return has been reducing by 5.5 times. So the first cycle, you got a 600 times return, next cycle 110, next cycle 20, and then this cycle's estimated to end up about 3.6. And that's because the market cap's getting larger over time. Now, Ethereum may just, I think this cycle get even with Bitcoin and potentially overtake it the next cycle. The merge is happening tonight. We're going from proof of work, which was forcing miners to basically sell $16 million worth of Ethereum a day. And now it's going to be the opposite. So what's happening now is there'll be less Ethereum over time. Just like Apple, it does stock buybacks. It's reducing a number of shares over time as the company grows, which has made Apple one of the best performing stocks in history. Well, Ethereum is going to essentially have that type of characteristic moving forward. And we're early. When we look at how long it takes to adopt technology and what percentage of people are actually using Bitcoin, it's very, very low compared to all the other technologies that have gone mainstream. So we're super early and a great time to get long. Other signals to go long crypto, the 200-week moving average has only been hit 4 times in history and has led to massive run-ups. Now in 2015, you could have bought it, had a nice run-up, and then a pullback and got scared and ran away, or you held, and a year later, you entered this massive 2-year bull market from 2016 to 2018. And that's exactly what I'm anticipating coming to crypto, especially for Ethereum. Same signal, only 3 times in history with the RSI. Now's a great time to buy. We had the worst month ever in Bitcoin, 40% decline. Worst quarter ever, 56% decline. And Ethereum is now going to have a higher dividend with greater growth potential than any other asset in the world. So let that sink in. Not only do you have a better yield by buying and holding and staking, the growth potential blows away any other asset that has a dividend, period. And the main driver for crypto is the growth of debt, and that is not going to stop. Here's a look at the federal budget deficit projection. We ran a $2.8 trillion deficit 2021. They've shrunk that to $1 trillion, but it's still $1 trillion, and that's going to run towards 2.3 trillion by 2032. Now, the big plan is to get emissions to 0 by 2050, and it's estimated it's going to cost something like $250 trillion. So don't worry, there'll be more shenanigans, more chaos. That's going to allow the government to run deficits way higher than this projection. And the benefactor of that long term is crypto. And so it's just, it's growing faster and faster over time. They're not slowing down. What took 215 years to build 7 trillion in debt happened in 2 years with the staged lockdown globally. Here's Ethereum trading at 1602, up 431% in the past 5 years after crashing massively at December of 2021 when the inflation was way hotter than anyone anticipated and collapsed the bond market. We're down 50% year to date, and the Grayscale Trust is down 55%. So a little discount window on Ethereum. Now, if you're a paid member, you have opportunity to get a leveraged Ethereum position with altcoins. So we're actually, if you think of Ethereum as the Windows operating system, well, what we're doing is we're getting the most successful software applications that are being designed on the operating system of Ethereum. And we're giving you exposure to those as well with leverage. So you replace your ETHE position with Rebel dividends. You get hyper growth with a weekly dividend payment. Call Dean to make that switch at 505-322-7515. Okay, step 5, buy 27 shares of FNGU. We're going to most likely move this to the safe growth strategy out of the high risk because it's gigantic companies that have monopolies that we're very confident in long term. And they have less growth opportunity compared to Ethereum or Bitcoin, but we get this free leverage with FNGU, so it's a beautiful product. Let's look at some reasons to be bullish on stocks. Risk investor appetite is at extreme lows. This has typically been a very good time to buy. We've got massive amounts of put options. Now, a lot of those got wiped out Friday, Monday, right before the big tank. But again, the market typically doesn't crash when everyone is prepared. This is just showing you Apple gobbling up half the stock market, just insanity. That's why we like Ethereum. We believe it will be the most successful crypto. That's why we're not investing in its competitors like Cardano or Solana or AVAX, because we do think this is a winner takes all world, and Ethereum really has the edge here. Bitcoin's nice, but it doesn't take out other sectors of the economy with technology. It's really just sound money. GDP tracker is recovering on Q3, showing after 2 quarters of negative GDP. Looks like we're starting to recover here. Another look at all the stock put options that have been purchased by institutions, and a lot of those got covered in the most recent rally Friday, Monday. Of course, that turned around Tuesday with the CPI. Now, when you are in midterm years, they tend to bottom later in the year and see large corrections. And so the average correction from the bottom is 33%. So if the Democrats are going to have a chance at Congress or Senate, they probably don't want a complete stock market crash unfolding. So most likely we're going to see some shenanigans. I think we're going to have a good print for October CPI and a very dovish Fed. November 2nd will be the next policy decision after September on Wednesday next week. Here's FNGU crashing from 45 to 765, screaming buy. We've got the biggest sell-off in the NASDAQ in its history. I think it tied it, or was a 0.5% off of tying it from the 2008 crash. So just a historic crash in tech related to the bond crash. S&P 500 is down 15.4% year to date. The NASDAQ down 22. Emerging markets down 21. Now Gunlack's thinking it's about time to get very long emerging markets and for a massive outperformance. This is showing you the few periods in time where emerging markets did outperform. And there's 5 in history. It's actually about every other cycle if you really look at it. So we've had 15 years of the US market greatly outperforming emerging markets, and likely this is about to transition. And this will be really coupled with falling interest rates, a falling dollar, and we're going to look for outperformance in EEM, crypto, and tech. Now the European market, we're keeping a close eye on. Are we about to have a Germany-style blow-up? So what I'm referring to is after World War II, or excuse me, World War I, Europe wanted reparations from Germany to the point it collapsed Germany. It collapsed all of Europe and eventually collapsed the US, sending us into a Great Depression and leading up to World War II. So if Europe's going to collapse, we want to not miss the warning sign. So far, it's having a very similar return of all the other indexes, despite their economies being imploded from these sanctions. To get to the clean energy goals, we're going to need a lot of uranium. And so we have a position in uranium in our safe growth strategy, URA. Here's its chart, down 3.4% year to date, but a big bounce of about 20% in the last month. Rare earth metals going to be in extreme demand to hit these climate change agenda goals. Another play in China, essentially, down 9% year to date. We have position in this in our safe growth strategy, mainly to be long lithium for batteries. Amazon's down 21% year to date. We're looking at some of the big boys, specifically in FNGU. Apple down 9%. Alibaba down 31% year to date this year, 50% last year. This is one of the cheapest companies you can buy in the stock market right now. This will be updated next week. Non-farm payrolls did cool off to the Goldilocks number in the 300s, which is good, not too hot for the Fed. Bank credit continues to grow. Consumer credit did fall to 23 billion. Again, this will be updated next week. I just got the screenshots to Ryan. Retail sales have been positive the last 3 months, so that's recovering, and they revised one of those months back up. We keep pushing to new highs in consumer spending, so a lot of demand. Balance of trade dropped significantly in this most recent month. Again, we'll update that next week, showing a slowdown in demand, which is good because we're betting on lower inflation. This fell to 510, so we're definitely seeing that cooling off in new housing sales, but not a 2006-07 type of crash that led to the great financial crisis 2008. China's PMI fell for a 3rd month in a row, showing a little bit of a cooling off, but their exports, imports remain very high. Step 6, buy 1 share of NRGU. So this is funny. The Saudis will cut output if oil drops below 90, and Biden will refill the SPR if oil drops below 80. So talk about a great put option. A Fed put is what we used to call it for the stock market. Well, we got the Saudi Biden put for NRGU. We love NRGU with oil above 80. And now with the market believing it's impossible to go below that or even 90, the reasons to be long NRGU are really good right now, especially if we're about to sanction Russia, who's been escaping the sanctions via Greece, China, India primarily. We did the greatest drop in the SPR in history last week, and still a lot of oil in there. So they dumped about half of it out, a little less than half of the total strategic reserve has been dumped into the market. This may end in October. So that's going to start putting upward prices back into oil. We're also seeing Europe have to switch out of natural gas to oil to heat because Russia's cut off all the natural gas. And it's going to take years for America to get all the ships and infrastructure to ship our LNG to Europe. So a lot of reasons to be long NRGU heading into winter. Edward Lutwick says Russia's ruler can do many things with impunity. He can spend hugely to satisfy his whims. He can enrich his friends and build extravagantly and more. The one thing he cannot do is lose wars, as Putin has been doing since February 24th. Now it's either mobilization or resignation. Breaking, the UK government freezes gas and electricity bills for average household at £2,500 a year for the next 2 years. So just leave those lights on 24/7. They're going to have shortages. This is a terrible idea. Now, is Russia really losing the war? Is this their plan? Kim.com says Russia's strategy to hold the line at minimal cost is winning the war. The energy crisis worsens in Europe. Inflation keeps rising, and the U.S. is spending significantly more to keep Ukraine afloat. Just last week, $14 billion, the biggest loan yet. And again, these are loans to Ukraine, not just free money. The U.S. strategy of unbalancing Russia backfires. Pentagon needs chess players. Now, this is before the great Ukrainian offensive. It does look like Russia actually abandoned that post to defend a more important part of Ukraine here, which I have a nice chart on. So the big battle is about to begin, and we'll take a look at that. So as far as pain to Russia, certainly blocking imports of chips and such is definitely hurting their economy. China is getting chips to them, which are not as high quality, but they still work. But here's the war map. So here's where we should focus. Let me get my little arrow out. Okay, so this is likely where we're going to see if Ukraine can take over this area, pretty much royally screws Russia. I'd say the war's over. And so essentially what we've seen over the past few weeks is Russia has abandoned this post, which is where Ukraine had this massive surprise attack and lots of success. But Russia has been moving their troops to here, here, and here. And this is the much more important territory to defend. So expect there to be a lot of fighting right here. And if Ukraine can make it to Mariupol, it really will be extremely bad for Russia here. So that's what we're going to focus on in the weeks ahead. I think we'll probably see this begin as soon as next week. Now, some things we've seen Russia do in response to the Ukraine attack has been hitting the energy for Ukraine, and they've been having lights out in big cities. So that is interesting development. 70, okay. Right. Some other just big macro pictures of what the overall strategy is. Alf says, this is a massive speech by Putin. The economy of imaginary wealth is being inevitably replaced by the economy of real and hard assets. His strategy is clear. Sticky inflation, which means higher real rates, needed, and that means paying for hyper-financialized economies, which is essentially Europe and the US has the great debt. So Janet Yellen says price cap on Russian oil is one of the most powerful tools we have to fight inflation. The banks say this will drive oil to 280 because Russia will simply shut off oil to cause massive pain. Zoltan, who predicted this chaos this year, really says the big picture is the US is preventing Russia from a monopoly in energy and blocking China from essentially rolling out 5G via Huawei globally and taking over the semiconductors in Taiwan to really compete with the US. And furthermore, the US wants to weaken Germany so they can't leave their alliance with the US. And the cost of this is going to be tremendous. It's going to force the US to rearm, to defend the world, reshore to get around blockades. We're talking about manufacturing, restock and invest in commodities, which we've not been doing for decades due to low oil prices, and rewire the grid, supposedly to go to this climate change agenda. So a lot of pain on all sides of the war. We'll see how this plays out. The big question is, let's assume Russia can get back on the offensive here, which again, the momentum is not in that direction currently. Would they really stop with Ukraine, or do they have greater ambitions, and how long is this expansion going to go? This is from Peter Zahan, and he lays out where he thinks Russia really wants to get their desired borders. So very good. Let's look at the chart. NRGU is at 486. I will dump it, or at least start reducing positions if we break to 600, which I think is quite likely if we sanction Russia, essentially. Here's the companies in NRGU. We got Conoco, Chevron, Devon, EOG, Marathon, Occidental. That's one Buffett owns half of now. Phillips, Pioneer, Valero, Exxon. Now, why is Buffett loading up on Occidental? It's to protect his gigantic Apple position. So very similar strategy with the growth value combo. Let's look at oil at 94, down significantly. So when the first attack happened in February, it was spiked up to 134. It's been falling ever since. And the only thing that would really get me worried about another bond crash below the 107 level on the TLT would be spiking oil back to new highs, which these sanctions we're talking about potentially could do. So we'll see if that really happens or not. Here's the 22% decline in oil over the past 3 months. That's the direction of inflation currently. And we got a picture of Exxon here just to give historical valuation of Exxon. We've only seen this similar in the Obama years. Okay, this is where your video ends. If you're not a paid member, we're about to reveal our exact strategy, track record, and both strategies, potential trade alerts next week. So call Dean to upgrade at 505-322-7515.